We have a great relationship. No, we were not happy with him buying oil from Russia, because that lets Russia continue on with this ridiculous war where they've lost 1.5 million people, by the way. Russia's lost 1.5 million people, soldiers mostly. This is a war that should have never started, but it's a war that Russia should have won in the first week, and they're going into the 4th year. And I want to see it stop. So I was not happy that India was buying oil. And he assured me today that they will not be buying oil from Russia. That's a big stop. And he's assured me there will be no oil purchased from Russia. I don't know, maybe that's a breaking story. Can I say that? Would you say? There will be no oil. He's not buying his oil from Russia. It started. You know, you can't do it immediately. It's a little bit of a process. But the process is going to be over with soon.
For most of the post-war era, the United States shaped global trade through the scale of its domestic market, the stability of its financial system, and the predictability of its institutions. Access to the U.S. consumer base was a central driver of export-led growth for dozens of economies, and the dollar's dominance gave Washington significant influence over global capital flows. But the structure of the world economy has changed. The U.S. remains a major economic power, yet its ability to shape global trade through market gravity alone has diminished. As a result, Washington increasingly relies on public statements, tariff threats, and diplomatic pressure to influence partner behavior. These tools were effective when alternatives were limited. Today, they operate in a global system where multiple large markets exist and where countries can diversify their trade relationships with far fewer costs. This shift becomes visible in the way the U.S. communicates its expectations. Washington now announces agreements that partners do not confirm, describes conversations as commitments that others deny, and frames policy preferences as shared positions, even when the evidence does not support that interpretation. These patterns reflect a broader structural reality. The U.S. is navigating a global economy in which its leverage is no longer automatic, and where emerging markets, particularly India, have the capacity to pursue independent strategies without jeopardizing their growth trajectories. The recent dispute involving India, Russia, and the United States illustrates this dynamic. Washington publicly stated that India agreed to stop buying Russian oil, but India has not confirmed such an agreement, and Russia has said it has received no indication that India plans to halt purchases. Meanwhile, India continues to import Russian crude at high volumes because it is affordable, reliable, and essential for supporting rapid economic growth. When a major power makes a claim that neither of the other parties validates, it highlights a structural reality. The U.S. cannot dictate energy decisions to countries whose economic priorities now rival its own. India's position in the global economy has changed dramatically over the past 2 decades. It is now one of the fastest-growing major economies, a rising manufacturing base, a technological hub, and a consumer market that will soon surpass the United States in population-adjusted demand. These fundamentals give India strategic autonomy in trade policy. Europe recognizes this. China recognizes this. The Gulf states recognize this. Japan recognizes this. All of them are expanding trade and investment ties with India because they see it as a long-term growth center rather than a peripheral partner. This economic weight explains why India can resist U.S. pressure without facing significant consequences. When Washington demanded that India stop buying Russian oil, India continued buying it. When tariff reductions were linked to India's energy choices, India waited. When the U.S. publicly framed conversations as agreements, India declined to endorse that framing. And when Washington suggested India shift to Venezuelan oil, despite years of sanctions and political pressure on Venezuela, analysts noted the inconsistency. The U.S. was discouraging purchases from one sanctioned country while encouraging purchases from another. This is not a coherent trade strategy. It is a reactive response to shifting global energy flows. The deeper issue is structural. The U.S. is attempting to redirect global oil trade, reshape alliances, and maintain influence using tools that were effective in a unipolar world but are far less effective today. Tariffs no longer produce predictable outcomes. Public pressure does not reliably shift partner behavior. Unilateral announcements do not create policy alignment when other countries have the capacity to contradict them. The global economy has diversified, and so have the options available to major importers and exporters. India's rise is central to this diversification. India trades with Russia because the price and supply conditions are favorable. It trades with China because Chinese supply chains remain deeply integrated into global manufacturing. It signs new agreements with Europe because the EU sees India as a key partner in green technology, digital trade, and industrial diversification. India is not aligning with any single bloc. It is aligning with its own economic interests, which increasingly diverge from Washington's expectations. Europe's behavior reinforces this trend. The EU has expanded trade cooperation with India, negotiated new agreements, and increased investment flows. Europe views India as a counterweight to both China and the United States, but more importantly, as a market that will shape global demand for decades. When Europe and India deepen ties, it signals a broader shift. The center of global economic gravity is moving toward Asia, and the US is no longer the default partner for major economies. China and India, despite political tensions, continue to trade at massive scale. Their economic interdependence is too large to unwind. China supplies machinery, components, and intermediate goods essential to India's manufacturing growth. India supplies raw materials and a large consumer base that Chinese firms cannot ignore. This is not a political alliance. It is a structural economic relationship that limits Washington's ability to isolate either country. As the US increases pressure, India diversifies further. As Washington uses tariffs, middle powers hedge. As the US makes unilateral announcements, other countries publicly contradict them. And as Washington attempts to force alignment, the world reorganizes itself around multipolar trade networks that reduce dependence on any single actor. This shift is not driven by anti-American sentiment. It is driven by economic diversification. Countries no longer rely on one market for growth. India has options. Europe has options. The Gulf has options. ASEAN has options. Africa and Latin America have options. When countries have options, coercive trade tools lose effectiveness. The US still has enormous economic weight, but weight alone is insufficient in a world where influence depends on partnership, predictability, and mutual benefit. Washington is attempting to use the tools of a previous era, tariffs, pressure, unilateral declarations, in a global system that now requires negotiation, coordination, and shared incentives. The result is a series of contradictions, claims that partners deny, expectations that do not materialize, and pressure campaigns that produce the opposite of their intended effect. India's role in this new landscape is especially significant. It is the only major economy growing fast enough to reshape global demand. It is the only large democracy with a population comparable to China's, and one of the few economies capable of engaging simultaneously with the US, China, Russia, Europe, and the Gulf without relying on any single partner. This structural autonomy limits Washington's ability to use traditional leverage tools. As long as the US relies on unilateral announcements and pressure-based strategies, it will continue to encounter resistance from countries that now have multiple viable alternatives. The United States remains a central actor in global trade, but it no longer operates in an environment where its preferences automatically shape the decisions of other major economies. India's rise, Europe's diversification, China's manufacturing dominance, and the growing economic weight of the Gulf, ASEAN, and the Global South have created a multipolar trading system. In this system, influence depends less on pressure and more on alignment of interests. Countries respond to incentives, not demands, and they calibrate their policies based on market access, supply chain resilience, and long-term growth potential. India's position illustrates this shift clearly. It is the only major economy growing fast enough to alter global demand patterns, the only large democracy with a population comparable to China's, and one of the few economies capable of engaging simultaneously with the U.S., China, Russia, Europe, and the Gulf without relying on any single partner. This structural autonomy limits Washington's ability to use traditional leverage tools. As long as the U.S. relies on unilateral announcements and pressure-based strategies, it will continue to encounter resistance from countries that now have multiple viable alternatives. The question for U.S. policymakers is not whether they can pressure countries into alignment. The question is whether they can adapt to a global economy where pressure is less effective, where influence must be earned through cooperation, and where emerging markets, especially India, play a central role in shaping the next phase of international trade. This is the economics behind the headlines.